Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs, and let's get you up to speed on the market action this afternoon. The Dow near the lows of the session, while the Nasdaq is holding on to gains up just about 0.5% thanks to Microsoft's strong earnings report. After the close, we will be keeping an eye out for Meta.
Plus, the battle between Disney and DeSantis heading to court. Details of a new lawsuit filed by the House of Mouse. Straight ahead.
The pitfalls of working from home. A new study revealing how younger workers are missing out on opportunities because they're out of the office. One of the authors of that study joins us next hour.
The battle between Disney and DeSantis continuing today, ratcheting up. The Walt Disney Company suing the Florida governor after a board appointed by Governor DeSantis voted to nullify two agreements that gave Disney control over expansion at the resort. Yahoo Finance's Alexis Keenan joins us now with more. Alexis, what are we learning?
Hi, Dave. Yeah, so Disney filed what is a 4-count civil suit against Florida Governor Ron DeSantis, as well as some other Florida officials. And what they're asking the court to do is to block actions that the company says are both retaliatory and unconstitutional. In this case, it's filed in the federal district court in the Northern District for Florida. Disney says that DeSantis has weaponized the state government to pass legislative measures that punish the company in retaliation for the company's public position on a Florida educational law that has become to be known as a Don't Say Gay law. Disney says that Florida's government both dissolved a special tax district where the theme park is located in Florida and also where it owns a majority of the land, and also that it voided lucrative land development contracts that the company said it entered into lawfully. Now, in its complaint, Disney says this: it's clear that it's a clear violation of Disney's federal constitutional rights under the Contracts Clause, the Takings Clause, Due Process Clause, as well as the First Amendment for the state to inflict a concerted campaign of retaliation because Disney expressed an opinion with which the government disagreed. Now, that opinion, of course, concerns that law, that Don't Say Gay law that prohibits state public school teachers from instructing students on sexual orientation as well as gender identity. The relief they're seeking, though, in this complaint, guys, it's not money damages, at least not at this point. What the company is asking for is for an injunction. They want the court to get involved and to issue an order that is allowing their contracts to remain in effect. And they also want the court to make a declaration saying that DeSantis's and the officials' actions are both unlawful and unconstitutional. Meanwhile, Yahoo Finance has reached out to DeSantis's office for comment, and we have not yet received a response, guys.
All right, thanks, Alexis. Of course, we'll keep tracking this story. We also want to get you up to speed on First Republic Bank. Shares tanking once again today, off just about 28%, extending yesterday's nearly 50% decline as investors await a potential rescue deal. Shares are halted. Right now, they've been halted multiple times for volatility during today's trading day. Now, according to Bloomberg, First Republic is exploring up to $100 billion in asset sales. First Republic shares trading at an all-time low today, market cap below $1 billion.
All right, let's get you up to speed now on news out of the tech world. Microsoft's $69 billion deal to acquire Activision Blizzard has been rejected by the United Kingdom's antitrust authority due to competition concerns. Yahoo Finance's Dan Howley is here following this story for us. Dan, what are we seeing now?
Yeah, so this is basically the UK's Competition and Markets Authority. They said that the deal, quote, threatens to alter the future of the fast-growing cloud gaming market and reduce innovation and less choice for UK gamers over the years to come. Basically, this deal has three main parts. There's Activision Blizzard makes Call of Duty. They publish Call of Duty, rather. That game itself made $1 billion 10 days after release. That's a lot of money from one title, absolutely massive. Microsoft clearly wants that to be under its wing. The other is the cloud gaming aspect of it, and that's where you're able to take low-power devices. If you have a Samsung Smart TV from like the last 5 years, I think you can get Microsoft's cloud gaming built directly into it. You just download it. You can play on your smartphone, your tablet, stuff that would normally cost you a $500 console, major PC to play. You can do that on a low-powered device. So that's the cloud gaming aspect. Microsoft wants Activision Blizzard and its titles to be a juggernaut in this space. By the way, they're already crushing Sony. The third part, though, is the mobile gaming aspect. And I think that's one of the underrated areas that people aren't necessarily talking about, but should. Mobile gaming is the fastest growing segment of gaming in the world. Microsoft wants that foothold. Activision Blizzard has King. King makes Candy Crush, which just annihilates as far as how much money it brings in for this little game on a smartphone. I'm going to have to talk to Activision Blizzard about my mom.
People are still playing that?
Absolutely.
People love it. They're
Love
addicted.
it.
I've never played it once. I'm sorry to get this off the tracks
down
here.
a
but
subway and you'll see someone just sitting there crushing some
Man.
candy. Yeah, there's different versions, but anyway.
playing Pac-Man too? What the heck?
I'm I'm not gonna lie, I'm on Microsoft Solitaire on my iPhone.
Yeah.
I don't know why, but I'm doing it. But so this mobile gaming aspect is really important because, okay, not everyone in developing countries can afford a smart TV or, necessarily a Chromebook or a MacBook. MacBooks aren't really good for gaming as much as Apple would want to tell you. But they do have smartphones. And so because they have smartphones, they can get a bigger audience connected there. And so Microsoft can jump into that. So it's three parts. Everyone's focusing on the Call of Duty aspect. Cloud gaming and mobile are really where it's at.
Dan, we're going to talk a little bit more about the impact to Activision here in just a minute, but in terms of the impact here to Microsoft changing the investor story at all, does it?
I mean, look, I think the investor story for Microsoft, anyone would agree, is driven by cloud.
AI.
And, well, AI now, cloud as well. I think, but, I think the idea that they could have had Activision Blizzard, they're going to appeal this. So maybe, if they make some assurances, they abide by them, they could still go through this deal, but then they have to also get through the FTC. This was going to put them the number 3 spot gaming worldwide behind Tencent and Sony. It would have made them a genuine competitor to Sony. Sony still puts out its own games that, I have Microsoft Game Pass, I have an Xbox and a PlayStation. Sony just, they put out better first-party games, and Microsoft can't do that, and they're trying to. This would have done that for them. I don't think they would have cut off Sony because they would be cutting off their nose to spite their face, just because they wouldn't be able to sell to as broad of an audience. So, I do think that for investors, for Microsoft, this isn't the broader story. It could have been if the deal had been approved, or eventually if it does go forward.
Good point there, right, Hallie? Thanks so much. Let's talk a little bit more about the impact on Activision Blizzard. Activision Blizzard today among the worst performers in the S&P after UK regulators did block Microsoft's deal to buy the gaming company. Martin Yang, Oppenheimer's senior analyst of emerging technologies and services, joining us now. Martin, it's good to see you here. So you cover Activision. What do you make just on the impact to Activision that this block over from the UK regulators is going to have on the company? And is the deal now dead?
I think you're on mute there, my friend.
I don't think the deal is completely dead. So Microsoft, as well as Activision, has committed to keep supporting the deal and will appeal to UKCMA, even though the win rate against UKCMA in the appealing process is close to 0. I think they're not willing to call the deal dead just yet.
What do you make of the argument from the UK? Microsoft has a strong position in cloud gaming services, and the evidence available to the CMA showed that Microsoft would find it commercially beneficial to make Activision's game exclusive to its own cloud gaming service. That was not the original objection we heard much about. What do you make of this argument?
Yeah, this argument is valid at face value, but in terms of real impact to the gamers and to the competition, it's immaterial. UKCMA essentially proposed an argument that Microsoft will find very, very hard to refute because the cloud gaming market is so small, and there's no valid data out there that will showcase, putting exclusive games on Microsoft's own cloud gaming service hurts competition. There's simply not enough data points. So that puts Microsoft and Activision in a very tough spot. Whereas the prior argument, regarding Call of Duty and other games exclusivity, that problem can be solved very easily with behavior remedies, such as Microsoft promised to put those games available on other platforms on a 10-year deal. So UKCMA is taking this different approach that puts Microsoft in a much tougher spot to offer a effective rebuttal.
So, Martin, you said that you don't believe that the deal is dead just yet. What does this do to the timeline of it? Is the renegotiation likely at this point?
Yeah, UKCMA appealing process can be a year or 2 years long. So this is going to drag the deal if both parties agree to extend the deadline into the next year.
Investors clearly believe there is significant impact. Shares down 11.5% today. What do you see as the investor story if, in fact, this deal is dead?
If the deal is dead, I don't think the stock can stay at this level for extended period. Today we're seeing a lot of the merger arbitrage guys repricing the stock, which is, taking a heavier hit on the stock. And let's say in the coming weeks, we do see the stocks, or without a deal, we do see the stock recovering to mid-80s price range, and that's based on fundamentals and the premium multiple over EA and Take-Two.
Martin, how are you looking at this just from a regulatory perspective and what that means for the broader gaming industry at large?
Definitely remove any potential M&A premium on large publishers such as Take-Two and EA. And definitely see that negative effect happening to those two stocks today. And this will make them more unlikely targets for big tech and big media.
Initially, Activision had made considerable concessions to get around the original arguments. That was before this new cloud gaming argument. Are there more concessions they can make in this aspect that might clear that hurdle?
They could, but this because the cloud gaming business model is so immature, so they could hypothetically propose maybe more flexible plans for future gamers to access the games on cloud streaming platforms, but those will be highly hypothetical. And but Microsoft will be willing to maybe make the access or the initial purchase of the game more flexible. So the key question is, Microsoft on paper does have an overwhelming advantage in terms of cloud gaming, and there will be no way for them to prove to UKCMA that other competing platforms can have similar access in terms of infrastructure and the player base. So that's, even though they can make some changes, but I don't think those changes will be enough to make CMA satisfied.
Martin, taking a look at these results that Activision did release early this morning, net bookings growing 25% year over year, mobile net bookings growing double digits on a year over year basis. When you take a look at the stock right now, what's the short-term catalyst without Microsoft?
Without Microsoft, it's going to be Diablo 4, which is expected to release on June the 6th. That is expected to be one of the biggest game releases. Early feedback based on beta testing is very, very strong. So that will be a multiple year earnings driver for Activision that are not completely captured by consensus just yet.
All right, Martin Yang, appreciate all that. Thanks very much. Just getting started here on Yahoo Finance Live. Still coming up, remote work has become a lot more common thanks to the pandemic. We'll tell you how giving women more flexibility at work may help increase loyalty. Plus, the NFL draft is tomorrow. We'll talk to a wealth manager who helps athletes decide what to do with those massive paychecks. And big tech earnings week rolling on. We'll bring you Meta's numbers and analysis after they report at 4 p.m. And be sure to stay tuned later tonight when Brad Smith and Diane King Hall take a deeper dive into Meta's numbers in today's edition of After the Call. Don't miss that. Big tech earnings sent the numbers higher today. Check out the Nasdaq up around 50 points, about 45 minutes before the close. Could tech stocks lead us to a summer rip? Bank of America thinks so, and so does our next guest. We have Ben Emmons, New Edge Wealth Senior Portfolio Manager. Good to see you. So a summer rip, that is a new one for me. Sounds good unless you read it. Looks like RIP, which could go the other direction. What's ahead for big tech after what we saw yesterday from Microsoft and Google?
Yes, indeed, the rip. And I think the right way to say it, I guess, is maybe RIP. On the one hand, the market being under pressure because of the banking crisis lingering. On the other hand, I think what big tech is finding out is that artificial intelligence is suddenly becoming this anticipated hype, but also something that's very important to them to try to continue to drive growth and earnings. And to some extent, what Google and Microsoft yesterday reported was that is going to be an important part of their business going forward. So the jump in Microsoft, particularly today, was driven by that view that they are the leader in the artificial intelligence and they're taking a real step forward. So that, I think, is behind that rip because, Microsoft has a huge weight in the Nasdaq, over 12.5%. So you can expect somewhat more outperformance from here as more news comes out of artificial intelligence and how it affects tech earnings.
So, Ben, it doesn't sound like that you think a lot of the hype that we've seen over the last several months surrounding AI seems to be overdone, at least to this point. But what about some of the risks that government officials are looking potentially to crack down on AI? What does that mean from an investor perspective?
Certainly something to account for because, like we've in a more extreme version have seen with the Chinese government, really, right? If you start cracking down, it's really quick getting a negative sentiment across the market. And so I think in this particular case, it's about, okay, is artificial intelligence going to reduce employment in the future in a major way? That seems to be the biggest fear. And that is to be seen. It's been around for a really long time. It's just a matter of how it's implemented and what it does to what is a good thing, productivity. People point back to this latest episode of AI boosting these tech shares, as in we're back in the 90s of technology is upgrading and therefore leading to the productivity boom. That's true, then that would actually be a really positive development for the economy. So it's a mixed picture, but I take your view that yes, the government will be very careful here in terms of having AI implemented that could then affect employment.
AI is certainly all the buzz. It was mentioned 50 plus times on the Google earnings call, but isn't the earnings story still all about the cloud?
Very much, and that's what drives it mostly. And I think that was for, in that particular case, Google, somewhat of there was a positive element in it, but it was not really driving the stock much today, as the AI hype, I think, overwhelmed the initial stage of the opening of the markets. But I think these companies are in a position here to still deliver top line growth. And in a weakening environment that we're dealing with, people pay up for growth. So can you get to higher multiples here? Yes, you can. But I also think that these stocks have at least longevity because it does show these companies can weather economic change, especially as we're going through now, which we're seeming to move more and more closer towards this point of recession.
Ben, let's switch gears here and talk about what's going on within regional banks because First Republic Bank was actually just halted once again. It's been halted a number of times throughout the trading day, a number of times since the top of the hour. How do you assess, or how are you assessing the risk that First Republic Bank faces right now, what that really means for the broader banking sector?
Yeah, it's certainly an issue because in the case of First Republic, it's really about seeing client assets very quickly going out the door now. That's a new dynamic compared to what we experienced with the deposit flight that we saw in March. And so I think this does give a signal to the broader market that the troubles are not over just yet. And the confidence issues are continue to be, I think, the main driver behind the depressed shares of regional banks, because as much as the Fed stepped in March, the regional bank index has not really recovered. Now, the rest of the stock market did, but not regional bank shares. So, and in addition, that those bank shares are really more closely linked to what's happening on the ground in the economy. And if it is weakening and it's going to lead to less lending, then their margins are going to continue to shrink. So I think it's a ongoing story. I don't want to draw necessarily a parallel exactly to what happened during 2007-8, but there's definitely a sign here of that as regional banks continue to weaken, it does point you to an economy that continues to slip. And I think that's the bigger message for investors.
As for First Republic, can they possibly survive without government intervention?
That's really up in the air right now, right? There's still a lot of call to get the private sector involved and infuse another, billions of dollars either through deposits or an equity infusion. So it's this sort of like stage that we've seen before with some other banks as we head towards the weekend, right? Another sort of like emergency situation. What will be challenging here is that the FDIC, already having stepped up quite a bit for the other deposit holders at Signature Bank in Silicon Valley, took a big hit on their insurance fund. So there's some limit there what they may be able to do in order to help out, in this case, First Republic. So it's really up in the air what will happen here. It's interesting to note, though, that it didn't have the contagion effect today as it did yesterday, and that was really because of the revelation of the earnings from First Republic showing this huge decline in deposits, that markets have digested it. But I think it will continue to be a lingering risk hanging over the markets into the summer.
And just resumed trading once again here, now off 36% today. Ben Emmons, great to have you. Thanks so much. Well, coming up, does your job allow you the flexibility to work from home and in the office? A new study out found that there are some drawbacks to remote work, especially for women. Stick around. Return to work is a hot topic since the pandemic left employees scrambling to set up home offices. And 3 years later, the name of the game is flexibility. Many workers are looking for hybrid or remote jobs, but there's a new study out from Deloitte that found some drawbacks to remote work, especially for women. Here with more on that is one of the authors of the report. We have Emma Codd, a Deloitte Global Inclusion Leader. Emma, it's good to see you here. So let's talk about some of the challenges, because I think a lot of people right now want that flexibility. What are some of the drawbacks to hybrid work?
So just to set the context, the research was 5,000 women across 10 countries. Amazing similarities in the responses that we got when we look at this at a global level. We focused really on women's everyday experiences, which include flexible and hybrid working. From a hybrid working perspective, last year, the data was really stark, very extreme. And I think that reflects the fact that we had gone back into the workplace for many of us. We were still in a bit of a perfect storm of everything that was going on in our lives. And from a hybrid perspective, 60% of women said they were excluded when working in a hybrid way.
From what?
Excluded in the workplace. So the age-old situation of you dial into a meeting, everyone else is in the room. It's not deliberate exclusion, but you may feel that way. So that was last year. This year, that number is down. So that number is now around 40%. That's still 4 in 10 women. So there are drawbacks to it. Women from a hybrid working perspective are telling us they're not getting enough access to senior leaders. Around 3 in 10 women saying, I need this access for sponsorship. It's really important. And yet, it's not quite working yet. And then we saw productivity, impacting issues like predictability. Women really want, everyone wants predictability. Women want predictability, flexibility. And then I think the final thing on hybrid is the messaging, with the employer that says, it's down to you, do what you want. And then the underlying messaging is, no, we expect you to be here. So from a hybrid perspective, challenges, but I think, we've seen improvement. It's an improving picture, but it's challenging.
You talk about the exclusion factor, but when you don't study men, how do you know this is a gender issue and not simply a remote issue?
And it could be. And look, we were doing a piece of research on women's views in the workplace, and therefore we did go out to women. And we went out, we've looked through an intersectional lens. So we've looked, from women in underrepresented groups and seen some interesting findings there as well. I think if we take flexible working, everybody wants to work flexibly. Our millennials and Gen Z research that we published, around this time last year, very clear that that's an expectation. So I'm not saying this is definitely not an issue for men as well. But with women, what we do know, and what the research tells us, is women hold the majority of the caregiving responsibilities still. Okay. Now, whether we like that or not, that is the data, and that's a lot of data telling us that. So for women, often when you're working in a hybrid way, many women have to stay at home. They have less of a choice in it. That's where the challenges come. I think, there is not so much the optionality there for them. They need predictability, and frequently they find themselves at home. That's where the exclusion becomes a problem.
Emma, what does this do then to burnout? Because a lot of people who want the flexibility, want that hybrid work situation, it kind of blurs the lines of when they are expected to respond. They're expected to respond sometimes at all times.
Yeah, and I mean, it's interesting. The burnout numbers, again, improved from last year. Terrible last year, still pretty bad this year, around 30% of women telling us they're burnt out. And the mental health data is very poor. So we've got women feeling more stressed, and actually women saying, I don't feel comfortable accessing support in my workplace. They feel less comfortable than last year. I feel less comfortable talking about mental health and disclosing it. That's really concerning. Whatever is going on there in the background, the picture is worse. And then the trouble is when you've got this always on number where it's like, I feel like I need to always be there. I need to be checking my emails. I need to know what's going on. And that leads to burnout. And we know that. And those mental health pieces of data are challenging, deeply concerning, that so many women, only a quarter of women feel that they would disclose if they have to take time off for mental health reasons.
And I know hearing from a lot of women, they also feel like they always have to be available for their kids when they're also working at home. So they also have to keep the phone on in case of school calls, etc. Conclusions, what needs to be fixed? Is it from the employer level, and what should be done?
What needs to be fixed? I can tell you, the women do not need to be fixed. big thing, okay? Not that I'm suggesting that you think that women need to be fixed, but the women absolutely don't need to be fixed. And I think that's too many organisations embark on what I call a fix the women approach. Look at structures.
In terms of this dynamic, in terms of supporting women that are working remotely, what can we do to fix the issue?
Inclusive leadership, predictability. Don't, make sure if you're having a hybrid meeting, make sure everyone knows where the majority of people are going to be. Make sure that people know in advance. I think as a leader, make sure that your expectations, that you're very clear that I expect you to be around for a particular time. I do not expect you to always be on. And then I think the final thing for me is, as leaders, inclusive leaders, at treating everybody with the utmost respect at all times. And if we do that, we will get a lot right.
Comes down to good management and transparency, it sounds like. Right, Emma Codd, great stuff. Thanks so much for joining us.
Thank you.
Well, coming up, we talk some sizzling trending tickers here, including one of the names on the screen hitting an all-time high today. We've got more on that when we come back. Time for a triple play. Three stocks that we're watching in the final 30 minutes of trading. Chipotle, Microsoft, and Tesla are the stocks today. Let's kick it off with Chipotle hitting a record high. Analysts cheering the restaurant's chain's margins that they just reported here, the trends that they're seeing there, also growing store traffic. More people are headed into Chipotle here. Solid Q1 report was enough for analysts to raise their price target, and that includes from the teams of Morgan Stanley, BTIG, and also Truist. BTIG thinks that Chipotle is in the, quote, early innings of restaurant margin improvement and does expect that trend to continue here throughout the remainder of the year. The rise in margins helped by lower avocado prices, also declining delivery expenses. And we can't talk Chipotle without mentioning pricing and their pricing power, because more customers did visit those restaurants in Q1, despite menu prices being up about 10% from where they were a year ago. So again, the stock hitting an all-time high today. Certainly something that the street is very excited about in this report.
Yeah, I mean, for you to be able to put up menu prices about 10% and still see more people coming in, given the overall environment we've been talking about, right, Dave? And we're talking about, in general, consumers maybe slowing down spending, certainly plenty of companies in the consumer space seeing that, maybe not the restaurant space, but fascinating to see them still getting more people through the door, and specifically them pointing out that some of them are low-income consumers. They said that the low-income consumer bounce back to the same level as what they were seeing from high-income consumers. Remember, last quarter, they had seen a drawback in that low-income consumer. So really not necessarily a trade down from anyone, but to see that low-income bounce back for Chipotle, those bulls are not cheap. It's not a cheap burrito.
No, but it's a lot of value, and you can't help but wonder how many people are going from a restaurant where you're sitting down to getting a burrito where you know you're going to get full. So a couple of analyst notes. Oppenheimer raised its price target to $20.50 from $19.40. Bank of America really spotted loyalty, and we talked about that with our analysts yesterday because loyalty up 20% in the first quarter, but it's also part of their technological edge. 39% digital sales were up. It's how they have all that data on you. They know what you are trading down. They know where you were trading up. That's a huge differentiator, and B of A has a buy rating and a $2,200 price target.
Yeah, it's incredible. What's your order? A lot of value.
I'm a burrito bowl guy.
Okay, same.
Barbacoa, half and half with carnitas. What's yours? Hold on, we got to get this done.
Barbacoa and chicken.
Barbacoa is good.
Yeah.
Okay.
Oh, all right.
Yeah.
What's yours?
Value, as
Barbacoa,
Dave
I would
said.
say, with the bowl. I'm
Wow.
not burrito. The burritos are too hard to eat.
Barbacoa bowl for the
They
win.
get too messy.
There was a time in my life, Dave, where it was bowl with the tortilla on the side, and then you could basically make a burrito.
You are
in
a
bowl.
pretty loyal
I used
Chipotle
to do
customer.
that as well.
But, you know,
Shrewd move.
they started charging for the tortilla. It's getting expensive over there at Chipotle
is
these days.
expensive.
All right, I got my eyes on another stock that's up today, Microsoft, and also Alphabet. Specifically, the difference that we're looking at here between Microsoft and Alphabet. You can see Microsoft taking a big jump higher today, up about just over 7% now, and Alphabet still barely over the flat line. And something I've been looking at today is the emphasis in search that we saw from those calls yesterday. So on one hand, you have Microsoft and Satya Nadella sort of championing search and their role that AI is playing in search. They saw 10% growth in search. And then you have Alphabet and Sundar Pichai basically defending their stance in search, at one point calling growth resilient. They saw 2% growth. Now, obviously, when we think about Alphabet, when we think about Google, search is still a major part of their business, obviously, over half of their revenue.
Still a verb.
And they're dominant in that space. But you're seeing what Microsoft wants to do with AI. So they came first to market with ChatGPT, right? And they came with that product. Now they want to bring that turf war to search, to Google's baby, and they're really sort of attacking them in certain ways in this call, and I thought that was interesting. You heard them mention Bing several times yesterday. They said that Bing downloads have now 4x'd over the last 2 months in that mobile app. They didn't even mention Bing last year on that earnings call. So a clear shift from Microsoft to say, hey, we want to talk about Bing and we want to talk about search because we're going to be a player here, and they're trying to come for Google in some ways.
It's interesting to hear 100 million daily active users for Bing. We don't have a frame of reference for that.
Sure.
So it would be really nice to know if that's up from 20 million or 90 million, but now we do have a marker. So next quarter, I hope that question is asked, how many daily active users, so we can measure the growth there. But Bing, 100 million daily active users versus 1 billion for Google, just for a little frame of reference. I did enjoy this quote from an executive who said, for every 1 point of share gain in the search advertising market, it's a $2 billion revenue opportunity. So that gives you a sense that every little bit they gain on Google, massive revenue opportunity.
It's a massive revenue opportunity. I was listening to the earnings call last night from Microsoft, and Satya Nadella was clearly on the offensive. He was very excited about the numbers that they were putting up. They were hyping their involvement, what they have done in AI. A number of times throughout the call, almost every single analyst question was regarding AI, with the exception of some that were asking about Azure Cloud, obviously very important to Microsoft right now. But a lot of the focus was on AI. And another thing that Satya did add here in terms of Bing, they said that the feedback that they're getting from the users that have adopted it so far has been very positive. So they're encouraged by what they're hearing. I think it's a massive opportunity for Microsoft, and it's a big reason why the stock is up, just about 20% year to date.
Okay, we got our burrito orders. Have you ever used Bing?
I still haven't.
I
Neither
have.
have I.
But I don't
And?
use it. It's fine.
Fine.
But I still
I've
go to
never even
Chrome.
considered using it. Yeah.
Google.
Still a verb, Google. All right, Tesla is my play. Shares slumping again today at a downgrade from Jefferies to hold from buy. The note spotlights the continued price cuts, of course, from Tesla, prioritizing volume over margins. Quote, however fascinating the investment case remains, relative price aggression is not supportive of a high multitude investment case while unfolding. The note also says Tesla has fallen behind in building skills in marketing and product planning. Heard a lot about that marketing story. Zero ad budget at Tesla. Jefferies lowering its price target to $185 from $230 though that's still pretty good upside, 20% even with that price target. Shares down almost 4% today, nearly 20% though over the last difficult month.
Yeah, certainly. And I think the street is kind of having a tough time whether or not this is short-term pain for long-term gain, which is what Dan Ives of Wedbush has said numerous times here at Yahoo Finance. On the flip side, a number of analysts here over the last week have lowered their price target. A lot of people are trying to figure out whether or not this is a huge disruptor move by Elon Musk lowering the price target in order to increase adoption, or if he's desperate right now because of demand falling. He has no other choice than to lower that price. So I think that the debate out there is very much whether or not this is going to work out well for Tesla. And I really don't know at this point.
Well, and I don't think Elon helped this last week either. It seemed like Elon doesn't know either, right? A lot of analysts coming out saying, where's the margin floor? And Elon set no sort of guidance for that, right? He was asked directly about the margins. How far do you think they'll drop? And he more or less said he wasn't sure, which is a fair answer to some extent, sure. But Wall Street likes a little bit of guidance and something to hold you to. And to not know anything, your stock's going to drop precipitously. I mean, you look at that stock. I was surprised today, a stat out there I saw, that's the lowest level it's been since January. And just how quickly that stock has slowly ticked down after it ticked back up, right? Year to date, I thought that was surprising. I think it's going to still kind of be in a weird, we don't really know phase, right? Until we get another look at basically what margins look like again come in another quarter.
Ad budget. Yes or no? Is he going to spend $1 on advertising this year or not?
We talk about him every day. Does he need you?
I don't know.
I think he does, yes.
Depends how bad it gets. I wouldn't be
does.
surprised.
All right, good stuff. Coming up, the NFL Draft kicks off tomorrow night. How should the players being picked spend their first big paycheck? We discuss how athletes can better prepare for their financial future on the other side.
NFL draft gets underway tomorrow with Alabama quarterback Bryce Young as this year's favorite to go number one. And while the top 5 picks will likely make tens of millions of dollars over the course of their career, the average player only stays in the league for less than 4 years. Here with what rookies need to consider when they are coming up with their financial game plan, we want to bring in Nicole Pullen-Ross, head of sports and entertainment solutions for Goldman Sachs Private Wealth Management. Nicole, it's great to see you here. So you're on the team. You help advise pro athletes, a number of them pro NFL players, on what to do with their money. So let's break down what some of these pro athletes need to consider. What is the first thing on that list?
It's a long list, and this is such an exciting time for the players. They've worked so hard to get to this point. So there's a lot of enthusiasm and excitement, and you're exactly right. What makes the most sense is knowing what's number one on that list. And the first thing on that list is exactly what you said. The fact of the matter is these athletes will earn a significant amount of money over a very short period of time. And so with the average playing time for an athlete in the NFL being 4 years, they have to move quickly to have a plan in place before they spend a single dollar.
So the dynamic 10 years ago was a bad one. 80% of NFL retirees were going bankrupt. How is that changing?
Well, it's changing pretty significantly. And I'd say the reason for that is because of advice. To your point, there has been a history of bankruptcy. When you think about work that EY did, for example, the number of athletes who alleged some sort of fraud from 2004 through 2019 was $600 million worth of fraud. And the NFL or football players represented about 150 million or 25% of that. And so with that backdrop and that trend in mind, I think that athletes have done a few things right, and we've suggested several. The first thing is to have the right team in place. As I mentioned, if you think about it, the NFL players, the top rookie contracts will be total contracts of $30 to $40 million a year. Over the course of 4 years. The average CEO of an S&P 500 company in 2021 earned $18 million during their 2021 year. And so these players have that $40 million that they may earn over the course of 4 years. And while that CEO has built his career building a team around him or her, the 21-year-old has not necessarily done that quite yet. And so the first thing they have to do is build a right team, build a team that can grow with them, that can help them think about the risks as it relates to taxes and trust and estate planning, have an attorney, have an agent. Building that right team is the very first step that the team members must put in place. The second step is to have a plan and to set the goals around how you plan to invest and what you want to have as an objective for your overall family. I say to the players all the time, act as a CEO, think as a CEO for your families. And the ability to do that is one of the things that gets players on the right course. The last thing I would say is to make sure that you have a protection plan in place. And so for athletes, if you don't do the protection plan, whether that be a will or revocable trust, those first two things, having the right team and having a plan in place, those won't really matter if you don't have the right level of protection in place for your family and for your future.
Nicole, a lot of these pro athletes do show some interest in investing. What are some of the biggest mistakes that you have seen some pro athletes make when it comes to these types of decisions?
The first thing is who they trust. Oftentimes we find that athletes are growing at a much faster pace than their level of advice, and trusting the wrong people is the first mistake that we've seen players make. The second, I would say, is looking around the locker room and looking to their looking towards their teammates and seeing what their teammates are doing and thinking that they should do the same thing. And so while a vet in the league may have a very different investment plan or talk a lot about what the winners in their portfolio might be, when someone is starting, when a rookie's getting started, they have to pace themselves and recognize that they have an investment horizon that needs to be built to meet the objectives and the goals that they have for themselves personally. So walk before you run. Owning a portfolio of Tesla, to your earlier comment, is not necessarily the right way to start. And so pacing yourself is one of the best pieces of advice that we give the rookies when they're getting started.
As someone who's covered sports for the better part of my life, I would say learn the word no. And don't do business with friends, because I have seen dozens of athletes do business with friends, and that money is gone. Lastly, is there anything that the ordinary person can learn from this advice? They haven't made any money. Maybe they're just graduating college, and they're coming into a substantial sum as they get a job. Who knows? Maybe it's at Goldman Sachs. Is there some carryover from pro athletes to the ordinary person watching this? What can they do with that first paycheck?
I would say the first thing they should do is really around education. To your point, being sure that you understand who is around you making those decisions is key. And with that first paycheck, it's really about making sure you understand how to think about risk and how to think about your goals. We have the privilege of working with athletes across every sports league and have had the privilege of talking to every player on every team for one of the leagues where we were given the privilege of doing the education discussion. And the things that came up are exactly as you're saying, relevant to many people. It is really about thinking through your plan, thinking through the strategy that's in place to do that. This generation of athletes has been a good leader for that. They've started with nil, and they have started a trend, I think, that is not just about the flashy, substantive or assets that aren't necessarily substantive, but they're thinking about their future and starting that way. So start with the future in mind is what I would say, and that's relevant for athletes, and that's relevant for anyone who's beginning to accumulate wealth and create a plan for their long-term goals.
Excellent advice for all of us. Nicole Pullen-Ross, head of sports and entertainment solutions, Goldman Sachs Private Wealth Management. Nice to see you. Thanks so much. Disney ramping up its battle against Florida Governor Ron DeSantis, filing a lawsuit claiming the governor is, quote, weaponizing the government over free speech. Yahoo Finance senior columnist Rick Newman joining us now. Rick, what does this reveal about Governor DeSantis?
I think it reveals he picked a fight he shouldn't have. This has been going south for DeSantis for the last couple of months. It started when Disney, it turns out they got this municipal commission to actually lock in their authority for something like 30 years before that commission expired and the DeSantis commission came into place. So what DeSantis has done recently is nullify what Disney probably got done legally and say, I'm just taking over Disney's authority anyway. And Disney is suing. So I can't tell you where the legal arguments stand on this, but look, this is a matter of professionalism and for Disney doing business in Florida. And you can imagine that they have smart lawyers who know what they're doing. And for DeSantis, it's all about scoring points against what he calls woke corporations. So DeSantis does not seem to have thought this through. I assume this is going to work its way through the courts. And guess when? We might get a final outcome here sometime in 2024, just as DeSantis is trying to convince people voting in the presidential election, and he's apparently going to run, that he's the right guy. He may lose this epic battle in 2024, just as he's trying to convince voters that he really knows what he's doing.
Certainly would not be the way that DeSantis wanted this all to work out. Rick, let's also talk about the latest drama in D.C. House Republicans getting a bit closer to passing a bill on the debt ceiling after a deal was reached overnight within the party. GOP leaders are trying to convince some of the holdouts. Are we any closer at this point?
Well, we are a little bit closer to the Republicans being able to pass their own plan. That does not mean we're closer to the whole thing getting resolved. But what has happened recently is a House panel gave a procedural approval to this Republican debt ceiling bill, which means that it will now go to the House floor for a vote. Let's call it 50-50 odds, or maybe a little bit better, that Republicans will be able to pass this. They're not going to get any Democratic votes, and they can only afford to lose, I think, 4 Republican votes. So almost every Republican has to vote for this. It now looks like maybe they have the votes. So if the House does pass this, that doesn't solve the problem because the Senate's never going to approve this bill. The Senate's controlled by Democrats, but it does move us one step forward in the negotiating process. So if it passes the House, and the Republicans can say, we passed our plan, now it's over to Democrats in the Senate and to President Biden, and then they will have to respond. So let's see whether it passes the House first, then we'll know what the next step is. And we don't know what the Democratic strategy at this point is going to be, but they will have to respond if it does pass, so that at least we would be getting a little more clarity.
Boy, you give it 50-50. That's better than I would have thought. Steve Scalise says a vote around 4:30 or 5, so we may have something for you today. Rick Newman, senior columnist. Good to see you, sir.
Hi, guys.
Coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live. All right, just a few minutes away from the closing bell. Let's bring in Yahoo Finance's Inez Ferre to break down the market action. Hi, Inez.
Hi, Dave. It looks like we are going to end off the lows of the session, but not by that much. We are going to end with mixed markets. The Dow right now is down 200 points. The Nasdaq is down or up 0.5%, and the S&P 500 down 0.3%. Looking at the sectors, it's really technology that's lifting up the Nasdaq. You can see technology really the only winner out of these sectors. Utilities, industrials, healthcare, those are the laggards. Over on the Dow, Microsoft up more than 7%. On the Nasdaq 100, Tesla is down more than 4%. Amazon, Nvidia, Meta, all of those are higher. Apple flat, and so is Google as well. And taking a look at the banks, this is what we have been watching throughout the day. The regional banks, it's First Republic, the one that's down 29% after it was down 49% as it's looking for a rescue deal. And then taking a look at commodities, we saw today pressure on WTI down more than 3%. Brent crude also down as well. Silver is up. Meanwhile, gold is down today. And checking out where we're at with Bitcoin, we have been watching Bitcoin moving quite a bit around. Bitcoin up more than 1%. It's down just a little bit, but remember, Bitcoin trades 24 hours a day. Here's the closing bell at the New York Stock Exchange.
All right, well, that does it for today's trading day. Again, we are going to close the day mixed. The Dow closing off at just over 200 points. The worst performers in the Dow today, Home Depot, Merck, and Honeywell. Nasdaq eking out some gains, up just about 0.5%. Some of those gains fueled by Microsoft on the heels of its better than expected report.
All right, let's take a look. Shares of Microsoft, as you can see, up more than 7% on the day. The stock continuing to rally after reporting better than expected earnings results on Tuesday and establishing its dominance in this early innings of the AI race, Shauna.
Yeah, it certainly is, Dave, and a lot of investors very excited about what they heard on the call as well from Satya Nadella, really touting the progress that Microsoft has made in the AI space with its investment in OpenAI and what they've done with the rollout of ChatGPT and really incorporating some of that technology into their products. Bing making some headway against Google, although Google obviously really owning that market when it comes to search. Satya Nadella, though, saying that the feedback that they are getting from those Bing users is positive. So you could really lead you to believe that maybe that trend is going to continue. But I think a lot of this rally, not only today, but really since the start of the year, has been fueled by AI.
Yeah, they said they're taking some market share, but we don't have context as to how much market share. It'd be nice if we had a marker for what exactly 100 million daily active users is compared to where they were, say, a quarter ago or prior to ChatGPT. So now we have a marker. Next quarter, we can see where that growth leads. Still a massive gap when you look at Bing / Microsoft's ad revenue, still at 18 billion annually, 200 billion annually for Google. So a massive gap. There's still a 10x factor.
All right, let's take a look at another big mover of the day, and that is First Republic. You can see selling off just about 29%, the second day in a row that we have seen massive declines in the stock. The stock closing off just about 50% yesterday. Now the pressure is showing no sign of easing as CNBC reports that the government is currently unwilling to intervene. And Dave, as a result, obviously the street taking a huge issue with this. Lots of questions about whether or not the bank is even going to survive.
It feels like it's going to have a hard time surviving the week at this rate of decline. I mean, it is staggering. No bank has survived 50% deposit withdrawals or fleas, and they were at 40 on their latest earnings. Now, just a little context on how far the mighty have fallen. This was a $40 billion market cap company in 2021. It closed today just above 1 billion. It was below a billion for most of this day, but almost all that value wiped out. It was a $219 stock. It is now just over $5 a share. Certainly need an asset sale, Shauna. That may not be enough. Will they get government intervention is the biggest question, and it doesn't appear the government is eager to jump back in here.
Yeah, at least right now. And of course, the question is, obviously, a lot of the thought as of late has been this is a very specific problem when it comes to First Republic, but it does bring up some of the concerns that we were talking about back in mid-March when we were worried about contagion, some of the risks that maybe it poses to some of the other regional banks that have been under pressure since the collapse of Silicon Valley Bank and Signature Bank. A number of those regional banks that have reported in the last several days, including PacWest, have shown that their deposits have improved pretty substantially. So that helped reassure some of the skittishness out there on the street from investors. But as you can see, lots of concerns about First Republic Bank, and obviously something needs to be done in order to stem the bleeding there.
Something fast. All right, Boeing shares ending the day. Let's check on them. Just eking out some gains, up about 0.5%. Rather surprising given the report. The plane maker reporting a 28% jump in first quarter revenue and reiterating its full year outlook. The company also boosting output of its 737 MAX planes despite a recent production issue. They say they'll deliver 400 to 450 737s this year. But the story has been, for as long as we can remember, supply chain issues plaguing Boeing. Dave Calhoun's got to get a handle on this, man.
He's got to get a handle on it, and I think that's a big reason why we haven't seen too much movement in the stock. We're looking at gains of just about 0.4% today, up nearly 3% in the last month alone. But when you take into account that Boeing did reaffirm their guidance, I think that did enough, or maybe at least for right now, to reassure some of the skeptics on the street. We know that the 737 is really Boeing's big money maker. So Dave, like you said, the fact that the company still believes that it will deliver 400 to 450 of the 737s this year, that they're going to increase production of those planes to 38 per month later this year, that obviously would bode well here for Boeing, and the fact that they stood by those full year or fiscal year guidance here, despite the fact that of the manufacturing defect that we know that Boeing has seen in its 737. They don't think it's going to dent delivery. They don't think it's going to have any impact, at least for right now, on their cash targets. So that's a big reason why we looked at that stock moving slightly to the upside today.
Still surprising, up 30% over the last 12 months. Really the face of supply chain issues persisting way out of the pandemic. Long way to go, but looks like things are on the up. EV sales jumping in 2022 compared to the years prior. The International Energy Agency releasing a fresh report on global EV sales and an outlook for the industry. Here with the newest numbers is Yahoo Finance senior autos reporter, Pras Subramanian. What are we learning, my friend?
Yeah, so the IEA is sort of combining here battery EVs and plug-in hybrids together as electric cars, they're calling them. So they're going to see that, they're saying that sales will jump 35% in 2023. Now, last year we sold globally 10 million. The industry sold 10 million globally. They're seeing 14 million units sold in 2023, and market share jumping from 14% to 18% globally for these electric cars. So one little nugget here is China still dominates that EV market. 60% of all electric car sales happened there last year. More than half of all electric cars in the world are in China. So a long way to go for the US and Europe to catch up, but it seems the trend is in the right direction there for electric cars.
Does certainly seem like the trend is in the right direction. So you mentioned some of the targets here, what's expected in terms of sales growth for 2023. What about looking further out, 2024, 2025? How quickly are we expecting some of that adoption of EVs?
So for 2030, the IEA sees EV share rising to 35% by the end of the decade. Furthermore, the US is going to hit 20% by the end of the decade, and Europe will be 25%. China, of course, will be at 40%. They're still going to maintain that lead. Now, it's kind of interesting because the Biden administration wants to have half of all cars sold by 2030 to be zero emission cars, which means the US is a long way to go. In addition to the fact that Europe wants to go fully zero carbon emissions by 2035, there's a huge gap there to kind of bridge between the IEA's prediction and what the European legislators want. So there's a lot of sort of uncertainty as to where that could be by the time 2030 and 2035 hit.
All right, Pras, great stuff, certainly. And then a lot of the infrastructure questions, exactly what it's going to take to really propel some of the Main Street adoption now. All right, well, coming up, we take a deep dive once we get those Meta earnings. We're expected those to cross any minute. The stock trading up just about 0.2% in after-hours trading ahead of those results. We're keeping a close eye on that. We'll be right back. Hilton is the latest company reporting strong demand for travel. The hotel chain's revenue per available room was up 30% in Q1 from a year ago, a sign that consumers are willing to spend and travel despite some of those higher costs. But we did get a new bank rate survey revealing that inflation is certainly having an impact on travel. 80% of those who do plan to take a trip are changing their plans because of higher prices. Now, here's what they're doing. Almost a third, about 29%, are picking some of those less expensive trips. 28% are engaging in cheaper activities while they are away. And 26%, about a quarter here, are taking shorter trips or fewer trips and choosing to drive instead of fly. So certainly, Dave, we've been talking about this pent-up demand for travel. People are very eager to get out and explore. With the fact that airfare remains so high, people are spending more in almost every aspect of their daily lives, are being forced to make some changes due to their budget. No surprise that people are opting not to fly and more are hitting the road.
Yeah, I'll just give you my own personal story. Was going to travel to Greece this summer, was 100% sure. Checked out the hotel prices, that knocked down 50% of my momentum. Then checked the flight prices, and that took out the other 50%. It was 3-4 times what I had expected, and I have flown overseas and have stayed overseas. I had never seen prices that even compared to this. Still surprising, though, to see 63% of U.S. adults likely to take a summer vacation this year. That's up from 61% from last year. So yes, they are changing their vacation plans, but still 63% of adults planning to travel this summer is a huge number. Also, another number for you, among the 37% of U.S. adults unlikely to take a vacation this year, the majority, 58%, say it's because they cannot afford it. Has it impacted your summer plans?
It has impacted our summer plans, because when you talk about buying plane tickets, a lot of times for our family, that means 4 plane tickets. So you're not just talking about yourself right now, you're talking about paying for your kids. And that has been a little bit of a rude awakening, I must tell you, because my kids are young. I didn't exactly take into account how much more expensive it is to travel with a family of 4 when you're used to just traveling with your significant other. But I think it's also going to impact, I don't think that this is the end of the road potentially for changes, because right now we're looking at a national average of gasoline prices of $3.65 a gallon. If we do see that number rise, we might see people changing their plans even more or opting to stick at home because they don't want to pay what they will potentially have to pay in order to fill up a tank of gas. But again, majority of the people are still looking to travel this season. So certainly we'll keep an eye on whether or not that changes as we look to gas prices. All right, let's get over to Dan Howley. Meta numbers are crossing the wires right now. Dan, what do you have?
Yeah, we have a beat on the top and bottom line. Revenue came in at $28.6 billion. That was versus estimates of $27.6 billion. EPS came in higher, $2.20 versus $2.01. Let's look at the advertising revenue. Obviously, that's the bulk of Meta's revenue, $28.1 billion versus estimates of $26.7 billion. Family of apps revenue was at $28.3 billion versus $26.8 billion. And then operating losses for Reality Labs, that came in at $3.99, I believe, versus $3.8 billion expected. They also came in higher for revenue in guidance in Q2. They're expecting between $29.5 to $32 billion in revenue. That's versus $29.4 billion expected. They did, however, say that they're expecting operating losses for Reality Labs to continue to increase moving forward. So they're plowing money into that. And I think the big deal here is that a beat is a beat for Meta at this point. You could see there, obviously, the share price surging higher here, 9% up. I mean, for them, this is just good news after quarter after quarter of bad news.
Yeah, and the magic word is it's AI, and Mark Zuckerberg in the release, our AI work is driving good results across our apps and business. We're also becoming more efficient so we can build better products faster and put ourselves in a stronger position to deliver our long-term vision. Just about every tech company puts AI in their first sentence or two, and Meta no exception, but a solid report given the atmosphere, given the macro, kind of better than expected as we've seen for most of this quarter.
Yeah, it certainly was a very strong report. And like Dan was just saying, when you talk about that revenue growth, Meta really turning around some of the momentum that we have seen, regaining their momentum after 3 quarters in a row of declining sales there. So that was a huge number here for Meta in its most recent quarter. I think a lot of the gains that we're seeing in after hours trading is because of the guidance that we're getting in its 2Q revenue outlook. That came in better than expected. Also some updates when we talk about Meta, the year of efficiency. That's something that Mark Zuckerberg laid out in the last earnings call. The company saying that it has largely completed its job cuts that were announced last year back in 2022. So again,
was that largely completed?
Largely completed.
Is that
so
leaving the door open?
A little bit more, leaving the door open, but they have completed. They're saying the majority of those job cuts that were announced in 2022. But again, the Reality Labs, I think that's something that you need to keep an eye on there, just in terms of the losses that Meta is seeing within that division and really what that looks like when we talk about the expectation for the growing operating losses, I should say, in terms of what that could potentially increase on a year-over-year basis, Dan.
Yeah, I think one of the things to look at is probably the Reuters report that had come out yesterday, I believe, basically diving deep into Meta and their AI capabilities or lack thereof when it comes to generative AI. You know, Meta has some of the best AI engineers in the world. I mean, that's, you know, it's what powers a lot of the technology behind Facebook, Instagram, the recommendation engines, things like that. And they've boosted that to better compete with the likes of TikTok. But as far as the generative AI aspect of things, they seem to be further behind than you would expect a huge company like this. It looked like there was some folly as far as the types of chips they were using. This is according to that Reuters report, again, basically saying they weren't using GPUs. Now they're using GPUs. They're developing their own chips down the line. But look, you know, I mean, after a series of you know, blunders as far as their reporting goes, and then these, you know, layoffs, I think it was 21,000 employees total that they had laid off. This seems to be at least some kind of good news for Meta.
And for investors, repurchased $9.22 billion of Class A common stock in the first quarter. Dan Howley, good to see you, brother. Great job. Thank you so much. All right, we'll be right back with some analysis of these earnings.
All right, well, remote work is high on the list of priorities for employees. A new survey out found that 98% of workers would like to be remote at least some of the time, but there are some challenges that come with remote work, and that study also found that there is power in proximity of work. Joining us now is one of the authors of that study. We want to bring in Emma Harrington, assistant professor of economics at the University of Iowa. Emma, it's great to see you here. So some of the drawbacks, some of the challenges of remote work, the importance of proximity. What was the number one thing that you found?
So our primary finding is that we find a significant downside of remote work when it comes to on-the-job training. Feedback is just harder to come by when you're not proximate to your coworkers in the office. And it's particularly striking in our context because we're seeing this even when we look at online feedback. So this is feedback that is entirely possible to exchange when you're not proximate, and it still declines when you're not having that face-to-face interaction.
How does that dichotomy change between young versus older workers?
So we find that the impacts are really concentrated among those people who you might imagine have the most to learn from their coworkers. So it's really concentrated among younger workers and among people who are newer to this particular firm.
Emma, how does it impact quit rates or churn that companies are seeing?
So we see an increase in quit rates, particularly among female engineers when they're no longer proximate to their coworkers. So it's a concern that you might have from a DEI perspective as well, that potentially losing some of that interaction may particularly harm certain types of workers.
Can you draw any conclusions as to why women are impacted more so than men?
So we see that this similar difference by gender also shows up in the feedback that people are receiving. And suggestively, a lot of it's coming from the follow-up conversation that people have about the code. So it's not the initial feedback you receive from your coworkers, it's that conversation about how things are going that happens afterwards. And so it may be that women feel a little bit more comfortable asking follow-up questions when they can do that some in person and some online, as opposed to only with virtual interaction.
There are some pros, though, of working remotely. What did you find in terms of productivity, how much that increased?
So we find a significant upside of remote work in the short term, that when engineers aren't sitting near their coworkers, they get a little bit more done in terms of the number of programs they write. That is particularly true among the more senior workers who are more experienced at the firm, who you might imagine were doing a lot of the on-the-job training that was occurring in the office.
All right, Emma Harrington, thanks so much for joining us here, breaking down the latest study, really showing the pros and cons of remote work. Let's get it back over to Meta. Shares popping here in after-hours trading. The company reporting a better than expected quarter, looking at gains of just about 9%. A lot of that being fueled by the guidance that we got. 2Q revenue outlook beating the street's estimates. We want to bring in Brent Thill, Jefferies' senior analyst. Brent, your initial take at these numbers?
Clean sweep for big tech. Microsoft, Google, Meta. We're still going through all the numbers, but I'd just say that expectations from tech investors are just way too bearish. Everyone thinks the world is taking another leg down, and we're not seeing that. You're seeing across the board, a lot of these names just put up very clean numbers. And the fear factor is that there's a giant boogeyman in the closet and it's going to take down tech again. And everyone's opening the closet and there's a giant teddy bear giving you a big hug. That's the analysis. It is. I've done this for a long time, and I've never seen how negative investors are in tech, and rightfully so. Right? We saw a big contraction as it relates to overall the sentiment last year in tech, and it was a hard year for all of us. But I think ultimately we just went to super over bearish, and again, great discipline on expense. You're seeing that now in earnings. They now have to demonstrate the next leg, which for the stock is really going to be the revenue re-acceleration. And so that's going to re-accelerate to mid to high single digit growth in the back half of the year. But we'll want to hear more about what's going to happen in the back half here and how they can pump that up. The checks that we have with advertisers is that they have lapped the iOS changes. They are seeing better ROI on the Meta platform, Instagram in particular. They are encouraged that Mark Zuckerberg has stayed out of the press, and that has helped for advertisers because they don't have to ask questions from their clients as you post a picture of him. So I think ultimately there's been many things that are going right, but I think the common theme here is, tech is stronger than most people think. Yes, we're fading, but things are a lot better than the bears have been expecting.
Teddy bears in this case, and you had me at the giant teddy bear giving you a hug here, Brent. The year of efficiency, how successful was it? Do you sense that the layoffs are behind Meta?
I don't think they're all behind. I think that, what they're learning is they can do this, and it's actually good for morale and shareholder value and employee value over time. And it's hard to go through these changes, but tech just got overweight. We talk about, way too many hires it couldn't support. And ultimately, I think even for some of those employees that have left, while it's difficult, it's actually the right thing for everyone. And there's an incredible surge of demand in a lot of other places. So I think ultimately what you've seen is a theme of belt tightening, a theme that we need to get on the Peloton more. We need to cut back our intake of food, and that's good. And we're seeing this across all of tech. It's happening, across the group. So I just say that I think this was needed. We needed this diet, and we think the health is being restored to the industry, and that's going to help everyone involved.
Well, it's certainly helping Meta stock here after hours. Brent, what do you make of the recovery? What's your sense of the recovery that we're seeing in the ad market? Because ad revenue here for Meta for the most recent quarter, $28 billion, better than what the street was looking for.
I think they've gained share back. I don't think advertisers are doing backflips and spending money like crazy. I think what's happening is Meta has improved their ROI. We've heard great examples from advertisers that they've been excited about their click-to-message product. They've been excited about the ROI that they've seen. They've been excited about the refocus of the company away from the metaverse back to the core advertising opportunity. So I think, advertisers all quarter in Q1 said, hey, things aren't perfect, but Meta is actually improving their competitiveness. And while all we could talk about last year was TikTok coming onto the scene, it was the new kid at school. It was the cool kid, and everyone flocked to that kid. I think now Meta's winning some of that back. I don't think that TikTok is lost it. I just think that Meta has stopped the bleed. Reels has gotten more attention. As I've said, we've gone from the mom and the girl dancing in the kitchen to now real content you can find on Reels that's relevant to whatever your like is. And we made that jump. We've seen some of their new advertising tools be announced last year, and these advertising tools are helping find new audiences for advertisers. They're helping make suggestions that perhaps advertisers didn't really know what was happening. And so there's AI infused, if you will, suggestions that are helping advertisers get more for their money. So I think overall, it was just consistent in all the checks that we run when we talk to advertisers that they're slowly gaining some of the credibility back that they lost through the iOS Apple change. And we've lapsed that now. They've gotten more focus. And I've said this, I think as they get leaner, they can be faster. And anyone that's gone on a no carb diet understands this. When you get off carbs, it stinks for a few days, but once you get to the other side, you feel a lot better. And I think they're on the other side of this now. They're not all the way through, but they're on the other side. That's going to make them a lot leaner and meaner and more efficient, and that should continue to help them drive, additional shareholder value. Again, we're talking about a stock that doesn't have a huge multiple. Still, even while the stock is up, close to 80% year to date. So there's still room to run, in our opinion, and that'll now come on the revenue reacceleration in the back half of the year.
Can't help but think of Zuck on a Peloton at the moment. They did have a massive Facebook glitch in terms of advertising over the weekend. Not entirely clear what the impact is. Maybe some refunds coming. Want to mention the buzzword that we have to get into, AI. Their CFO says 30 to 33 billion in capital expenditures, reflecting their build out of AI capacity to support ads, feed, reels, along with increased investment in capacity for our generative AI initiatives. How well positioned are they on AI?
I think they're extremely well positioned. I mean, they talked about this last October that their big investment wave were in these new AI clusters. And I think anyone that's been on Instagram, and I've been on a long time, they really populate what is relevant to you. And I think they've always done a great job, and advertisers have always believed that the relevance of whatever you're interested in, that it would represent that to you. And so I've said this repeatedly, I don't think people care if they're advertised to, they just want to have the right content, the right music, sports, entertainment, whatever you're into, they want to have that geared. And I think it's only going to get better in terms of as they continue to build out these AI clusters. And that will come in the form of written content. It may be in stocks, it may be in music, it comes across different forms. So it may not just even be a picture. I mean, it could be a video. And I think, again, I'm at the Jefferies Private Internet Conference meeting with a number of AI companies right now in Santa Monica. And I just say that overall, I think many have felt that the day for AI would come. I think it's here. I don't think it's hype. I think a lot of this is real. You're already seeing it show up in Microsoft's numbers. That's starting to aid their Azure business and will add their applications business. So for the companies that are going to benefit, it's the companies that have big user bases and content, and that's Meta, Amazon, Google, and Microsoft. So I think they're in a great position. It's still the AI wave fully hasn't hit yet, but it's to come. But I'd say just to be clear, I think they've already embraced AI and done a really nice job of recommendations in the past. And I think it feels like it's only going to get better, but it's already really good. And that's why advertisers are spending here. That's why you're seeing the numbers that you're seeing. And so I think, the biggest concern has always been it's fueled by a lot of SMB, small and mid-sized advertisers. And, that the health of SMBs have been called into question. I think clearly they're feeling healthy. Large enterprises feeling okay. Overall, I mean, big tech's feeling a little bit better than I think most people thought. So that's good. We found the teddy bear, not the monster in the closet.
Hugging teddy bears, cutting carbs, hopping on the Peloton. Jefferies Brent Thill bringing it. Good to see you. Thank you, sir.
Thank you.
All right, coming up, the struggles within the commercial real estate industry and why are office owners starting to diversify. We'll talk real estate realities next. The commercial real estate industry is grappling with work from home challenges, higher interest rates, and the consumer slowdown. All were hot topics at the Commercial Observer Spring Financing CRE Forum today. Our very own Diane King-Hall was there. Diane, sounds like an awful lot to talk about.
Indeed.
Not a lot they want to talk about.
I know.
Not a favorable environment.
Right. How do you solve a problem like the woes of the commercial real estate industry, the real estate industry in general? But again, this session focusing on commercial real estate, difficulties going all the way back to the pandemic, now to a difficult interest rate climate. We talked to Kathy Cunningham, who took us through a bird's eye view of the challenges the industry is facing and what's ahead. It's Kathy Cunningham. Let's take a listen.
I think the last year has been a very volatile year. We've seen a lot of capital sources retrench. So we've seen the banks retrench. We've seen the CMBS, commercial mortgage-backed securities market, really not be as efficient as it normally is. The CLO market, collateralized loan obligation, also not efficient. So what it's done is really whistled down the available financing pool to a very select group of lenders. Now the flip side to that is that these lenders now really they can cherry pick the best deals for them. So competition is very scarce, which also works for them. So there's opportunity in the clouds, if you'd say.
So how would you characterize the deal landscape now?
It really is asset type specific, I would say. I think multifamily, industrial, which were really the most coveted asset classes during COVID, continue to be the asset classes that investors are flocking to. On the other side of that, office, especially Class B office, is the asset type that nobody really wants to finance today. So a lot of concerns about the maturing office loans that are coming due soon.
And so Class B, I have heard that Class B buildings are struggling more now, Class B, Class C. But in particular for Class B, since you see more and more companies calling people back to the office, can that help, or is it still just the troubles are too much right now for that sector?
I think it definitely can help, but I think the troubles in that sector, they're so pronounced now because of COVID. What COVID did was really kind of change the power dynamic also, almost where the tenants are now the people with the power and they can demand what they want from a property. So really only the best, flashiest, greenest, most attractive buildings are securing tenants. So it's really been a flight to quality within the office that we've seen now for a few years. And this now feels almost like the boiling point for office, where the worst, or not the worst, or the least attractive office buildings are at a point where they already struggled for a few years and now they can't get financing. So it's not a good situation.
Commercial real estate was deeply affected by the pandemic, as many other industries, and it's struggled to recover. Do you see has it completely changed how commercial real estate operates, or do you think there will be a move back to how it was pre-pandemic?
I think it's probably a change that we're going to see last for a long time. I think what COVID did in terms of the real estate market is really give real estate a chance to breathe and really kind of figure out, everybody's portfolios, what they look like, what tenant demand looks like. And that flight to quality was really the theme. So when it comes to office, especially flight to quality, when it comes to the asset classes that are performing well, I think people are far more diversified post-COVID in terms of not having their portfolio completely weighed toward office. Instead, we see a lot of office owners now pivoting away slightly from office to multifamily, industrial, even retail, just to basically diversify their holdings more. So I do think that the pandemic was a fundamental change for our industry in terms of just changing the landscape and what commercial real estate looks like and is used for.
And speaking of multifamily, what are you seeing with regard to plans for conversion, especially with, we did an interview with Bill Rudin and he talked about how in years past you saw conversions happen downtown Manhattan. Do you think more of the industry is moving or will have to move towards that?
I think a lot of them certainly want to. I think if you're an owner of an office building that is not performing or is functionally obsolete, which is a phrase we hear all the time just now, I think that's definitely the hope that you might be able to convert that building into a multifamily building. And also it helps solve the housing shortage in New York City. But not every building is ripe for a conversion. It really depends on the floor plates, the glass. It depends on so many different things whether or not that building could be converted. So I think while a lot of owners would love to do that, it's not necessarily going to be an easy fix for a lot of them.
Let's talk about just the headwinds in general. The interest rate climate has been challenging for commercial real estate. The banking sector, problems in that have its impact on the sector. How are institutions in the real estate, in commercial real estate, preparing for and the headwinds that we have currently in front of us and a little bit down the pike?
Well, I think the banking crisis, what it did was really kind of wake a lot of people up, because we've been in a period of volatility for about 10 months in the rising rate environment. But I think a lot of people were kind of kicking the can down the road when it came to refinances and what their own portfolio would look like in terms of maturing loans. I think now that's being dealt with more forthrightly because there's no choice. I do think there's going to be pain over the next year or two, as first of all, the distress that's currently in the market plays out. And also, I think there's going to be volatility in the system. Even after rates stabilize, there's going to be a lot of volatility in commercial real estate. It's going to take the banks a longer time to come back and actively lend again. So I think until we have a functioning market on the banking side and less volatility, it's going to be a very tough market for a lot of the owners of commercial real estate.
So indeed, certainly some challenges within the commercial real estate sector, Dave. And one of the common themes that we heard throughout our interviews with Bill Rudin, the CEO of Rudin Management, and Rob Verone, Laura Rappaport, they're experts in the industry, was that the need for conversion. You have a housing crisis in the U.S., so there could be a way where the problems in the commercial real estate sector could be a solution in another capacity. But you really need public sector support for that, like tax credits, et cetera.
Yeah, because the values are dramatically different in terms of office versus multifamily. Far more valuable for office. Plus, there's the issue of plumbing, which is massive. The types of windows they use, the walls that are load-bearing. It is. People think it's simple. It is a massive challenge.
Need some tax abatements to help with that.
No doubt. Diane, thanks. Great stuff.
All right, you got it.
All right, coming up, tech stocks leading the way this earnings season. How can you position your portfolio to take advantage of the gains in the sector? Straight ahead. The tech sector ending the day higher on some positive earnings results from Microsoft and Alphabet. Then Meta popping in after hours trading after beating on the top and the bottom line. A pretty solid beat. Checkout shares up more than 12% after hours. Tech been on a wild ride so far this year with double-digit gains for some of the biggest players. So how can you position your portfolio to ride the highs of these stocks? For that, we turn to Dave Nadick, VettaFi financial futurist, as part of our ETF report brought to you by Invesco QQQ. Good to see you, sir. You heard the question, how can you ride this wave?
Well, it's been a really fascinating thing to watch because I think we've got this bifurcated market. There's part of it that is driven by consumers. And when we're talking about the tech story, it's really a consumer tech story. The big tech spends on things like CapEx investment. We're not seeing those kinds of big top-line earnings hits that we'd love to see. We're seeing Microsoft, Apple, Google, Meta. Those are where the action really is. Those are consumer technology plays of a sort, and that's where we've seen a lot of the activity. If you look at across different sectors, we recently at VettaFi picked up a company called Logically, which lets us dig down into portfolios of ETFs and figure out what's driving their returns. The biggest winner this year has been QUAL, which is the iShares Quality Factor ETF. When you look at what it holds and what's driving the pattern of returns in it, it's communication services, it's technology companies, it's better picks in the consumer discretionary space. That's what's driving these funds to gain assets, but also to beat the market. QAL is beating S&P by about 1.5% so far this year.
Dave, do you think that momentum, though, can continue? And how much of it is a result of all this hype around AI? Meta reported tonight, and it was in their second line of this release.
Well, I think AI is a lot more real than it is hype, even how much hype there is, not because we're all going to go buy something with AI on the label and we're going to spend a lot of money. It's going to allow businesses to really change how they do business in a positive way. It speeds up time to market. It speeds up product development. It makes marketing better and more targeted. There are real use cases here that are driving real flows.
When it comes to some of the other sectors that we have heard from so far, a number of the consumer staple stocks have reported over the last week. We heard from PepsiCo, Coca-Cola, Procter & Gamble, just to name a few. How are you looking at investment opportunities within that sector?
Well, it's worth pointing out that staples and discretionary had a really flipped year last year, where staples did quite well. Discretionary really took it on the chin. That's flipped around a bit. Staples is actually dragging down the S&P so far this year. Discretionary is really leading. But even saying that, if you look inside the Staples earnings reports, we see a consistent theme of price over volume, meaning everything from Tootsie Roll to Kimberly-Clark to Pepsi seems to be able to pass not only their increased costs on to consumers, but to juice their margins along the way. We've seen no evidence yet that the average consumer is pulling back their spending just because prices are up.
You don't see the beginning of some consumer pushback saying, okay, this might be our tipping point. We've started to see some commentary in quarterly earnings reports that suggests that's just beginning to appear.
I mean, I think people should be concerned about that. Prices won't be inelastic forever. At some point, the consumer will respond. What we're finding out is there was room to raise prices, and that's what companies have done.
And so, how do you benefit, how do you invest off of what you're seeing from the consumer?
Well, I think the kinds of stocks that you're in matter. If you look at the kind of flows that we've been watching at VettaFi, we're seeing a ton of focus on what I would call safety plays, but still in equity. Whether it's things like UAL, which has pulled in a lot of money, or the JP Morgan Equity and Premium Income Fund, JEPI. I think it's the second or third largest growing fund this year so far. Dividend strategies like the Schwab Dividend Fund, SCHD, all pulling in good flows for good reason. They're investing in the companies that are most benefiting from this price over volume mix, or by being in the right place at the right time, owning, for instance, a lot of Meta.
Are you seeing, we asked this probably too much, is there any sign at all of a recession, or is it complete lack thereof? We've got a tight labor market, and I already cut you off. Go ahead.
No, it's all good. I think there are concerns, but I think the concerns are mostly on the corporate side, not on the consumer side. I'm worried about things like the credit crunch actually clamping down on CapEx. I'm worried about business growth. Those things can really hurt the economy, but the core S&P 500 companies can actually do pretty well while we're still in a recession in other parts of the economy. That's a bit of a bifurcated market. It's not something we see very often, but that's the kind of recession I think we're headed into if it is a recession. If the consumer gets really spooked and starts keeping all their money in money market funds, because we don't use banks anymore apparently, then we should be concerned, but we really don't see it in the sentiment numbers or in the actual volume numbers.
AAA said international travel is up 300%. I say the consumer's doing all right.
Yeah, travel, services across the board.
Remarkable. Dave Naden, good to see you, sir.
Thanks for
so
having
much.
me.
All right, Shauna, what's moving after hours?
All right, Dave, we've got 4 names for you here. Meta, Roku, eBay, and Teladoc, all having to do with earnings. Let's kick it off with Meta. You're looking at gains of just about 12% right now in extended trading. An impressive report here from the social media giant. 2Q sales outlook. That was one of the headlines here, coming in better than what the street was looking for. Also posting beats on both the top and bottom line. Meta reporting a 4% increase year-over-year basis in ad revenue. Also a 4% increase in daily active users. Meta, one of the names entering that AI race, is in the second line of this earnings release. And Mark Zuckerberg, the CEO, saying that our AI work is driving good results across our apps and our business. Year to date, we're looking at gains of just about 74%, really recouping many of the losses that we saw back in 2022 on a one-year basis. The stock now up 15%. Let's flip it over to Roku, another mover here in extended trading. That stock up just about 3%. A couple of big headlines. 2Q revenue outlook also better than what the street was looking for here. A narrower than expected loss in the first quarter is also helping to drive some of the action that we're seeing play out in extended trading. Q1 sales up 1% on a year-over-year basis. Roku also announcing a partnership with Instacart. Now, this is all geared towards marketing, and Roku says that they are going to better help companies like Instacart target their audience. Roku saying that it's going to be able to track whether or not people are buying products after they see the Instacart ad. So we'll see whether or not that really pays off here and what that could mean for the future of the advertising space. But we're looking at year-to-date gains of just about 38% here for Roku. Moving on down to eBay, the third company in a row that we've talked about with better than expected 2Q sales guidance. One of the drivers here in after hours trading up just about 3.5%. Profit and sales for the first quarter also coming in better than expected. Year to date, looking at gains of just about 4.5% over the last year. The stock's still off about 18%. And rounding it out with Teladoc Health, that stock up about 5% here in extended trading, reporting a narrower than expected loss per share of 42 cents. The street was expecting a loss of 51 cents. They also lifted the bottom end of their full year revenue guidance, so the street taking that as a sign of confidence here for the company for the remainder of 2023. You can see that stock off just about 55% in the past year. Remember, Teladoc is one of the names that Kathy Wood has been betting on. She recently added to her position in Teladoc in one of her ARC Innovation funds. It's one of the top holdings there. We'll see whether or not she is right about the future of this company. Year to date, Teladoc is up just about 9%, Dave.
The only thing we've said more than AI is better than expected.
Better than expected. Lots of beats.
To sum up the entire quarter. Thank you, Shauna. Coming up, we recap the day's top business stories and get you all set for Thursday.
It's closing time here at Yahoo Finance. Let's get you caught up on the biggest stories of the day. First up, Meta reporting its first quarter results after the market closed. The social media giant beating analyst estimates on both the top and bottom lines. Guidance was also rosier than expected. The beat sending Meta shares higher after hours, looking at gains just about 11.5%.
Disney suing Florida Governor Ron DeSantis. Disney alleges DeSantis is punishing the company for speaking out against a bill that restricts teaching gender identity and sexual orientation in kindergarten through third grade. Disney says DeSantis' efforts to take control of its special tax district are, quote, patently retaliatory, patently anti-business, and patently unconstitutional.
And the UK's antitrust regulator has blocked Microsoft's $69 billion bid for game maker Activision Blizzard. In its announcement, the Competition and Markets Authority said that the deal would have led to, quote, reduced innovation and less choice for UK gamers over the years to come. The companies say that they are going to appeal the decision. Now, Microsoft ending the day higher, most of that because of the earnings results that we got after the bell yesterday. Activision Blizzard, though, that was enough to send shares lower, closing off just about 11%. And be sure to tune in later tonight when Brad Smith and Diane King Hall take a deeper dive into Meta's numbers in today's edition of After the Call. You won't want to miss that.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell.